Hello friends, welcome back to another video. Friends, this video is second mock test for Certified Credit Professional Examination. Now, if you missed the previous one, then the link for that is there in description of this video. So do watch that important mock test as well. Now friends, this mock test contains only conceptual and case study based questions which are very important for your upcoming examination. I will cover many important concepts from which questions can be asked, and especially don't miss out question number 6 of today's mock test. Now the concepts that we will cover today are, first one is loan syndication. Then we will also cover capital adequacy calculation for this year's balance sheet of Union Bank of India. Then next we will cover ECNOS concept, that is export credit not otherwise specified. Then next is Kisan credit card limit calculation. Then next we will also cover differential stamp duty. Then next we will cover the concept of DCCO for infra projects, that is date of commencement of commercial operations. After this we will also cover the concept of RAROC and some other concepts as well. So do stick till last of this video since all these concepts are very important for your upcoming CCP examination. But before moving ahead, don't forget to get your CCP 1000 series question bank from the links given in description to this video. Now friends, please note IIBF no longer asks cakewalk questions in your CCP examination. Focus is on checking concepts, and so concept clarity is very important. So this is the question bank which is specially designed with upgraded difficulty level and at par with real examination level questions. The key features of this book are, first, it contains 1400 plus questions and case studies and numericals distributed in chapter-wise format for your easy learning. Then all the case studies, numericals and conceptual questions comes with detailed explanations. Not only this, you get my full support with respect to any issue from the question bank. Also, it's updated after every 6 months, so you always get updated materials. Now all the links are there in description of this video, so do get after you finish this mock test. So friends, let's start with today's mock test, and the first question is, now this question covers the concept of types of borrowers, and the case goes like this. A bank is approached by a married woman who applies for a high value personal loan to fund her business expansion. She provides detailed financial statements indicating sufficient cash flows from her business. However, she insists that her husband should not be involved in any way with the loan. Upon deeper scrutiny, the bank discovers that the assets she intends to pledge include a property that was transferred to her as part of her marriage settlement. The bank, however, remains concerned about the implications of her financial independence and the legal status of the assets. Now, considering the complexities of lending in such scenarios, under what circumstances, if any, could her husband be legally obliged to repay this loan, despite his non-involvement in the loan application and documentation? And the options given to you are these. Now the first option is, if the bank later discovers that the business was co-owned by her husband and the wife at the time of loan sanction, irrespective of his absence in the loan agreement. Then second option is, if the property offered as collateral is subject to ancestral claim under the Hindu Succession Act, regardless of the woman's financial independence. Then third option is, if the loan was taken by wife for necessities like household expenses or with the express written consent of the husband. And last option D is, if the property pledged is identified as Stridhan and the husband subsequently become a co-borrower by virtue of his legal guardianship. Friends, I hope the question is clear to you. So please note, while a married woman is typically considered independent for financial purposes, her husband can still be held liable if the debt is incurred for household necessities or if it was taken with his explicit consent. Now friends, this is in line with both legal provisions and traditional banking practices concerning financial liability within marriages. So as far as this question is concerned, the correct option is option C. The next question is a practical case of Union Bank of India and covers the concept of capital adequacy. And the question goes like this. Union Bank of India's March 2024 Basel III disclosure report indicates that the bank's CET1 capital is 912,059.32 million, Additional tier 1, that is AT1 capital, is 89,286.49 million and tier 2 capital is 130,668.99 million. The report further states that bank has a total risk-weighted asset, that is RWA exposure, of rupees 66,80,836.05 million. Now, as part of its stress testing, the bank evaluates a scenario where its CET1 ratio drops by 50 basis points due to higher provisioning for NPAs. Simultaneously, the bank anticipates a 3% increase in its tier 2 capital due to regulatory changes. Given these assumptions, what will be new total capital adequacy ratio, that is CAR, for the bank? And these options are given to you. Now friends, this is a very good conceptual case scenario with some twists. So let's first analyze this question. We are given CET1 capital, additional tier 1 capital, tier 2 capital, and finally risk-weighted assets for Union Bank of India for the year ending March 2024. Then the question says that management of the bank wants to do some stress testing, and so they drop the CET1 ratio by 50 basis points and simultaneously increase their tier 2 capital by 3% due to regulatory changes. And we have to find the new total capital adequacy ratio. Now friends, you all know that total capital adequacy ratio is calculated using total eligible capital divided by risk-weighted assets. And total eligible capital is nothing but CET1 plus AT1 plus tier 2 capital. So you just need to find the change CET1, AT1 and change tier 2 capital and then plug all these into this formula to get the new capital adequacy ratio. So this is the blueprint of the question. So the question has two parts. One, original figures given, and then second, the changed ones. So let's first find the original CET1 ratio, which we can do using the relation, that is CET1 ratio equals CET1 divided by risk-weighted assets multiplied by 100, which is 912,059.32 divided by 66,80,836.05 multiplied by 100, which equals 13.65%. Now friends, let's move on to the change scenario. So after a 50 basis point decrease, the CET1 ratio will become 13.65% minus 0.50% equals 13.15%. Now using this, we can easily find new CET1 capital as well. That is, new CET1 capital equals 13% of 66,80,836.05 million, which is nothing but 878,459.99 million. Then friends, in the question it also says that tier 2 capital increases by 3%. So the new tier 2 capital will be 130,668.99 million multiplied by 1.03, which approximately equals 134,589.06 million. So friends, we can find the new total capital, which is new CET1 plus AT1 plus new tier 2 capital, which is equal to 878,459.99 million plus 89,286.49 million plus 134,589.06 million, and which comes out to be 1102,335.54 million. So finally, the new capital adequacy ratio will be 1102,335.54 million divided by 66,80,836.05 million multiplied by 100, which equals 16.44%. Thus the correct option for the given question is option B. The next question is, now the concept covered in this question is forms of lending. And the question goes like this. A manufacturing company requires substantial working capital to finance its expansion into multiple states across India. The company prefers an arrangement where it can negotiate terms independently with each bank and avoid the constraints imposed by a formal consortium structure. Additionally, the bank wants flexibility to deal with each bank separately without any shared risk or collateral arrangements. Given these requirements, which of the following banking arrangements is most suitable for this borrower, considering the credit from more than one bank without interdependence among them and the freedom to negotiate with each bank on individual terms? And the options given are these. That is, first one is consortium lending, then second one is syndicated loan, then third one is multiple banking, and last option D is project financing. Now friends, to answer this question, you must be aware of all these terms. So first, consortium lending involves pooling resources from multiple banks with a formal credit assessment process and shared risk. Now, syndicated loan is where a lead bank assembles a group of lenders under a single loan agreement with coordinated terms and risk sharing among participating banks. Now friends, multiple banking is an arrangement which allows the borrower to independently approach and negotiate with different banks without any interconnection or shared collateral among the banks. Lastly, in project financing, specialized lending institutions finance long-term infra or industrial projects with shared risk management and centralized credit monitoring. So friend, I hope by now the correct option is clear to you. That is, correct answer for the given question is option C. That is multiple banking. So friends, please note here multiple banking is the arrangement which aligns with the company's needs, and in multiple banking the borrower independently negotiates terms with each bank and avails credit separately without any contractual or collateral relationship among the banks. But friends, please note there are many loopholes in multiple banking, and also it can lead to various frauds. So this is the least preferred way in banking industry. Next friends, if you are enjoying the content, then please like this video. It really helps me to know that you are loving the content. Also, do comment from where you are watching this video. Simply your city or location. It's in fact great to connect with bankers from different parts of India. Next, let's move forward with our mock test. And the next question is, now it's from very important concept of RAROC. And the question goes like this. Consider a financial institution that is analyzing the performance of three distinct departments, that is corporate lending, retail lending and treasury using RAROC metric. The following data is given to you. That is, for all these departments, interest income is given, non-interest income is given, expenses, expected loss and regulatory capital is given. Now, assuming a tax rate of 25%, determine which department is most profitable on a RAROC basis, and these options are given to you. Now friends, RAROC, that is risk adjusted return on capital, is a risk based metric that helps financial institutions measure profitability and also assess the health of their portfolios. In fact, it's a common way to calculate expected return on capital employed and is especially useful for banks. Now, RAROC takes into account expected losses and income generated by capital and assumes that riskier projects should have higher expected returns. Now friends, this question is simply based on the formula of RAROC calculation, which is RAROC equals risk adjusted profit after tax divided by regulatory capital. Now this numerator can be expanded in this form, that is interest income minus expenses plus non-interest income minus expected loss divided by regulatory capital and whole of this multiplied by 1 minus tax rate. So please remember both these formulas as questions can be asked in any form. So just pause the video and try to calculate RAROC for each department yourself. So friends, RAROC for each department will be, now for corporate lending, RAROC will be 800 minus 600 plus 200 minus 100 divided by 2500 and whole of this multiplied by 1 minus 0.25, which comes out to be 12%. Then for retail lending department, RAROC will be 900 minus 700 plus 250 minus 120 divided by 3000 multiplied by 0.75, which comes out to be 15.63%. And finally for treasury department, RAROC will be 1000 minus 800 plus 300 minus 150 divided by 3200 multiplied by 0.75, which equals 15.23%. So as you can see, retail lending has the highest RAROC of approximately 15.63%, and this makes it most profitable. Thus the correct option for the given question is option B. The next question is also from important concept of Insolvency and Bankruptcy Code 2016. And the question goes like this. An MSME has defaulted on a payment of Rs 15 lakhs and intends to resolve its financial distress through a pre-packaged insolvency resolution process, that is PPIRP. However, during the assessment, it was revealed that the MSME underwent a corporate insolvency resolution process, that is CIRP, 2 years ago and successfully implemented a resolution plan. If the MSME applies for PPIRP, which of the following legal and procedural hurdles could disqualify its application under IBC 2016? And the first option is, the MSME cannot initiate PPIRP as it underwent a CIRP within the last 3 years, which violates the eligibility criteria set under IBC. The second option is, the MSME's previous CIRP does not affect its eligibility for PPIRP, but it must first obtain approval from 15% of its creditors to initiate the process. Then option C is, the MSME is only ineligible if its default is below Rs 10 lakh, so the previous CIRP is irrelevant for initiating the PPIRP. And last option D is, the MSME can still proceed with PPIRP provided it secures a 66% majority approval from its creditors in the initial meeting convened for the resolution process. Now friends, pre-packaged insolvency resolution process, that is PPIRP, is available for resolution of stress of corporate MSMEs. Now friends, please note, pre-packaged insolvency resolution process, that is PPIRP, is basically available for resolution of stress in corporate MSMEs. Now MSME is eligible to apply for initiation of PPIRP if it satisfies these conditions. That is, first condition is, it has committed a default of at least Rs 10 lakhs. Then second is, it has not undergone a PPIRP during the 3 years preceding the initiation date. Then third one is, it has not completed the CIRP during the 3 years preceding the initiation date. Then fourth one is, it is not undergoing a CIRP. And last condition is, it is not required to be liquidated by an order under section 33 of IBC code. So can you guess the correct answer now? Well, yes, the correct answer to this question is option A. Friends, according to IBC 2016, a MSME is ineligible to initiate PPIRP if it has undergone a CIRP in preceding 3 years. Now, this restriction ensures that MSME do not misuse insolvency mechanisms without fully resolving their financial distress. So the basic objective here is to maintain the integrity of resolution process and prevent repeated insolvency filings within short intervals. Friends, next question is from very important concept of DCCO, that is date of commencement of commercial operations. And the case goes like this. A commercial infrastructure project has encountered unforeseen delays due to legal disputes leading to arbitration. The date of commencement of operation, that is DCCO, was initially scheduled as January 1, 2022. The bank has already allowed an extension under the first deferment policy. Now, considering the delay due to arbitration, the borrower is requesting another deferment. According to RBI guidelines, how will the bank determine the maximum permissible deferment period for classifying the account as NPA? And these options are given to you. That is, first option is, DCCO can be extended up to January 1, 2026 without classifying the account as NPA. Then second option is, DCCO can be extended up to January 1, 2024 without classifying the account as NPA. Then third option C is, the DCCO can be extended up to January 1, 2025 without classifying the account as NPA. And last option D is, the DCCO cannot be extended further without classifying the account as NPA. Now friends, this is a very important question with respect to your coming examination. It's a newly introduced concept, and so you must understand this concept very carefully. Now friends, as per latest regulations, the instructions for shifting of DCCO without the account being treated as NPA is as per this table. So just pause the video and look at this table very carefully. Don't get frightened by seeing this table. It's an easy table to remember. So as you can see, deferment will only be because of any of these 4 given cases. So first, see if the project given in the question is infra or non-infra. Now in our case, it's given as infra. Now it's given in the question that bank has already allowed first deferment, which as you can see in serial number 1 is D+2. Then next deferment is due to arbitration, that is serial number 3, which is also for 2 years as per this table. So the total deferment will be D plus 2 plus 2, that is D plus 4. So in our case, it will be 2024 plus 4, that is 1st January 2026. So the correct option for the given question is option A. Now also note friends, had the project was non-infra project, then in that case, total deferment would have been D plus 2. Friends, I hope the concept is clear to you. On first deferment, the date was extended by 2 years. Then next, in case of arbitration, the date was another extended for another 2 years. So the total deferment was D plus 4 years. The next question is from the concept of ECNOS. And the case goes like this. An exporter of pharmaceutical goods received a confirmed export order and applies for pre-shipment credit from a bank. The bank extends the credit facility to cover the procurement of raw materials, processing, packaging, and warehousing of goods until the shipment is completed. However, due to unexpected logistical delays and global supply chain distribution, the exporter is unable to ship the goods within the expected time frame. As a result, the submission of export documents is delayed, extending beyond 360-day limit specified for the credit facility. The exporter argues that these delays are due to external factors and requests the bank to retain the preferential interest rate granted for export finance. What action is the bank most likely to take regarding the interest rate application considering the regulations on export credit facilities? And the options given are these, that is, first option is the bank may retain the preferential export credit interest rate but require a detailed justification from the exporter supported by external documentation. Then option B is the bank will immediately convert the credit into a regular commercial loan and apply a standard commercial interest rate, disregarding the reason for delay. Then third option C is the bank will apply the export credit non-otherwise specified, that is ECNOS interest rate from the date of advance, including a penalty, and reclassify the loan as non-performing asset. And last option D is the bank may extend the credit period by an additional 90 days, after which the preferential rate will be replaced with the penal ECNOS rate if the situation remains unresolved. Now friends, first of all, you should never get frightened by the lengthy wordings of the question. In this question, the only thing you should know is that there is an exporter whose submission of export documents is delayed beyond the 360-day period. Now friends, in cases where the export documents are not submitted within the 360-day limit, regardless of the reasons, the advance will cease to qualify for the prescribed export credit rate and will be reclassified as export credit not otherwise specified, that is ECNOS, with a penal rate of interest applied from the date of advance. Not only this, the loan may also be treated as NPA if the delay persists and the export proceeds are not realized within the permissible period. So as far as this question goes, the correct option is option C. The next is an important question from KCC, that is Kisan Credit Card Scheme. And the question goes like this. A marginal farmer with a land holding of 0.8 hectares applies for a flexible KCC limit under the small and marginal farmers category. The farmer's crop cycle includes both Kharif and Rabi crops, with a scale of finance of Rs 25,000 per hectare for each crop. The farmer also requires credit for post-harvest expenses, consumption needs, and also crop insurance, considering a 20% addition for post-harvest expenses, 10% for consumption needs, and 5% for crop insurance. Calculate the total KCC limit for first year. Additionally, if the farmer continues the same cycle for the next 5 years, determine the revised limit for second year considering a 10% increase in the scale of finance each year. And these options are given to you. Friends, I hope the question is clear to you. If not, then please reread the question. And if you understood the statement, then please pause the video and try the question yourself. So friends, the first year limit can be calculated as, that is, crop finance for the first year will be 0.8 hectares multiplied by 25,000, which is scale of finance per crop multiplied by 2, that is 2 crop cycles. Now on solving this, you will get Rs 40,000. Also, there are post-harvest expenses of 20%, which is 20% of 40,000 equals rupees 8,000. Then consumption needs are also 10%, which is 10% of 40,000 equals 4,000. And also there is 5,000, which is fixed for crop insurance. So for first year, the limit will be rupees 40,000 plus 8,000 plus 4,000 plus 5,000 equals rupees 57,000. Then next, the second year limit considers a 10% increase in scale of finance, and this makes it rupees 27,500 per hectare. That is 25,000 plus 10% of 25,000, which equals 27,500 per hectare. So as we have calculated earlier, let's calculate the revised limit again, which is 0.8 hectares multiplied by 27,500, which is new scale of finance per crop multiplied by 2 equals rupees 44,000. So for the second year, the limit will be rupees 44,000 plus 20% of 44,000 plus 10% of 44,000 plus 5,000 equals rupees 62,200. But as you can see, we can't find our answer choices exactly in the options given. 57,000 is there, but 62,200 is not there. So if in examination you face same scenario, then go for the best or closest choice, which is option B in our case. So as far as this question goes, the correct option is option B. The next question covers the important concept of differential stamp duty, and the case goes like this. A multinational company headquartered in Delhi is involved in a cross-state transaction for acquiring a manufacturing unit located in Karnataka. The transaction involves a complex series of documents, including agreements for the property transfer, equipment lease, and service contracts. Each of these documents are executed in both Delhi and Karnataka. The stamp duty for each document in Delhi is rupees 80,000, while in Karnataka it is rupees 1,20,000. If the documents are first executed in Delhi and then presented for execution in Karnataka, what would be the required legal and procedural steps to ensure enforceability in both states considering the differential stamp duties and potential tax implications? And the options given to you are these. That is, first option is the full stamp duty of rupees 1,20,000 must be paid again in Karnataka to validate the documents there. Then second option B is the document should be re-executed entirely and the applicable duty of rupees 1,20,000 in Karnataka disregarding the stamp paid in Delhi. Then option C is the documents needs to be adjudicated by the stamp authority in Karnataka, paying only the difference of rupees 40,000 before execution. And last option D is an appeal must be made to the stamp authority in Delhi to adjust the stamp duty before presenting it in Karnataka for validation. Friends, please note, when a document is executed across multiple states with varying stamp duties, the differential amount needs to be paid in the subsequent state. Differential stamp duty is basically the difference in the amount of stamp duty levied between two states, typically the state in which the duty is executed and the state in which it will be acted upon. Now in our case, since the document is first executed in Delhi, the difference of rupees 40,000 should be paid in Karnataka before the execution. Additionally, the document should be presented to the stamp authority in Karnataka for adjudication, ensuring it complies with legal requirements in both the states. So the correct option for the given question is option C. So friends, finally we have reached the last question of this mock test, and this pertains to syndication of loans concept. And the question is, which of the following statements are correct with respect to syndication of loans? Now the first statement is, the term syndication is normally used for sharing a long-term loan to a borrower by two or more banks. Then second statement is, this is a way of sharing the risk associated with lending to that borrower by the banks and is generally used for large loans. Then third statement is, the borrower intending to avail the desired amount of loan gives a mandate to one bank called lead bank to arrange for sanctions for the total amount on its behalf. And last statement 4 is, a lead bank does the licensing work and common terms and conditions of sanction are agreed in a meeting of participating banks arranged by the lead bank. Now these answer choices are given to you. Now friends, this is an easy question, and please note that all these statements 1 to 4 are correct statements. All these are in fact important features of syndication of loans. So please remember these features, as loan syndication is favorite topic of IRBF people with respect to your certification. So friends, with this I wind up this lecture. Do revise all the questions before your examination. Also, don't miss to get your CCP 1000 series question bank from the links given in description of this video. So thank you, and I will meet you again in another video.